Hey everyone, welcome back to the channel. Tom here. Today we are going to be talking about whether the stock market is currently in a bubble or not. Now, there's obviously a lot of fear going around at the moment. We've had this crazy sell-off in tech, and a lot of media articles are comparing it to the dot-com bubble of the 2000s, but I think there's a lot of differences to then. And actually, you know, I saw this the other day and it made me laugh. If this story, which was printed in the Daily Mail, which is a big UK newspaper, one of the most read papers in the UK, this was printed in 2000, and if that doesn't show you why you shouldn't listen to the media, then I don't know what does. But let's have a look at what Cathie Wood said. She's obviously a very well-respected investor. She released a video just this week talking about these kind of fears and uncertainties. Let's hear what she had to say, and then let's break it down.
We are not in a bubble. Although compliance would have me say, I do not believe we are in a bubble, is because the seeds of what we believe will happen during the next 5 years, so these 5 innovation platforms involving 14 technologies, the seeds for all of them were planted more than 20 years ago in the tech and telecom bubble, and even before that, so the PC and the internet together. And then the internet, of course, the bubble, caused a rush of capital into they were actually the dream at the time. The dream was right. It was just 20 to 25 years too early. Amazon maybe being an exception, an important one, and showing the way. And so therefore, we're in the period of reality. The seeds are beginning to flourish. We are ready for prime time. That is what we truly believe. And so this notion of a bubble, I think, is born, once again, out of the benchmark sensitivity and backwards-looking nature of a lot of institutional investors out there. I know there's a lot of fear, uncertainty, and doubt evolving in the world out there, but we're doing a lot of original research. We have a 5-year investment time horizon. And we are truly excited about the opportunities that the last few weeks have presented us. As you know, our minimum hurdle rate of return for any stock to enter our strategies is 15% at a compound annual rate over 5 years. That's a doubling over 5 years.
So there we have it. Cathie really thinks that we're not in a bubble. She didn't mince her words. She thinks that the high valuations in tech and growth at the moment are justified because these companies are so disruptive. And she thinks that this short-term correction or sell-off is just a great buying opportunity to average in and get good prices. She talks a lot about the volatility and how it's become a dirty word, but really it's just a good opportunity. So when stocks are down, you buy in when they're cheap. When they're really high, you sell some when they're expensive, and it gives you a chance to get your average price that you pay for those stocks down and get higher returns in the long run.
Well, you can imagine what has happened over the last few weeks. Market activity alone has taken that projected rate, and again, it's just a projection. We could be wrong. The world could end. I'm sure I have compliance monitoring me very carefully when I say this, so I want to say it correctly. But according to our projections, what these last 2 weeks have done is handed those who are averaging in to these sorts of strategies, any innovation strategies, a gift, because we do believe we're on the right side of change. And disruptive innovation, transformative innovation is going to deliver exponential growth trajectories for many of our companies. In fact, most of them. The growth rates are enormous, and I think some people find them unbelievable. To give you an example, electric vehicles. We expect unit sales of electric vehicles globally, including China, to compound at an 82% annualized rate during the next 5 years. Most people, when they see a number like that, they'll just say, I don't believe it. It's not possible.
So I think that was quite interesting. She talks about how crazy the growth is in some of these disruptive sectors like EVs, for example. They're predicting an 82% compound annual growth rate. Now that is absolutely crazy. That's a 40x return over the next 5 years. Sorry, not a 40x return on investments, but in the growth of these companies. So you can see why these might justify high valuations, because the future is just so bright for them.
I know that institutional investors are much more short-term, many, not all, and they're very focused again on the benchmark. So this idea of being graded every year based on how well an analyst or portfolio manager did relative to a benchmark is quite constraining. The luxury we have, and retail investors have, is retail investors really don't have career risk. We might have a little bit more of that, of course, given what we do, but we have a 5-year time horizon. That is a luxury. That's a luxury.
I think it's an interesting thought what she says there, that a lot of these investment managers are just way too short-sighted because they are measured against how they do in each individual year against the benchmark, which is obviously a difficult situation to be in, and it's a bit like being a politician, right? A lot of them are measured about exactly what they're doing whilst they're in office over those few years, when really they should be judged over the changes they make over much longer terms, like 5, 10, 15, 20 years, because compounding is where you can really make the difference in life. But obviously if you're measured and judged against something you do in the short term, you're not going to care about what you do when you don't have a job anymore or when you're out of office, because it doesn't affect you anymore. And it's a bit of an unfortunate sort of side effect of the current world, I guess, and how we are so short term about everything.
And then in terms of what's happening in the markets today, let's address the equity market. There's a big rotation taking place. It's moving from growth into value. Now, this started in the fourth quarter, and the surprise to us is that our strategy had held up as well as it did until the last 2 weeks. We were beginning to think, oh, maybe they can coexist. Well, we don't think they can coexist, but what I'm about to say might surprise you. If you're the algorithms out there, and the market is highly algo driven these days. We learned that from the coronavirus, when algos just ripped through the market and sold stocks that had small cash cushions and were in a cash burn situation. And many of those stocks held solutions to the problems. So they were cut by 2/3 at that time. It made no sense. But these algorithms, if they're given just two variables, they're probably going to make a lot of mistakes. If the variables they're using today are price to book and dividend yields, then we think that they're going to be very wrong, because those kinds of value stocks probably haven't been investing very aggressively to become a part of the new world and the innovation that's burgeoning today. There are value managers out there, very good ones, who understand their biggest risks are value traps caused by innovation. So they're picking their spots very well. But be careful, because value, we believe, is going to continue to face massive headwinds, especially those companies that have not invested to move into the new world. Increase in energy, that's almost what makes me feel good about what's going on. If you look year to date, energy stocks are up 37.5% and financials up 13%. Much of that occurred in the last month. 22% increase in energy just in the last month, and 8% in financials. So that accelerated appreciation is what has caused this rotation algorithm saying, okay, past is prologue, it's happening faster, let's get rid of our growth stocks and let's go into value. The fact that those two sectors are at the top of the league tables this year and in the last month makes me feel good from a couple of points of view. One, the bull market has broadened out. It did not narrow into one strategy like the internet in the late 80s. That was a recipe for the tech and telecom bust that we saw. So this rotation is healthy, a good correction, shakeout. is healthy, great time to average in to strategies you like.
So there's some quite interesting points there, talking about the algorithms and how they're not trading in the way that is going to be very effective. They're effectively moving money from tech into the recovery plays, the blue chip value stocks, and that might work for a short while, but a lot of these value stocks aren't investing heavily enough. And with this massive disruption that's happening over the next 5 to 10 years that Ark Invest and Cathie think is really going to disrupt the whole economy, these value stocks are just going to fall behind because they won't have invested and they won't be able to keep up with the new innovative companies. And I think that's a really interesting point.
The last few weeks hasn't done anything except increase the returns that we expect from each of our stocks to the extent they've come down. It's only the market that has changed that because a 5-year investment time horizon doesn't, the research doesn't change.
So really, Cathie is just reiterating the same sort of few points there. She doesn't think we're in a bubble. She thinks this is a healthy correction. The market's broadening out, which is a good sign because it means all the money isn't being focused in tech. It's spreading out amongst other sectors now. It's a healthy correction, which is giving us basically a sale of cheap prices to buy back into some of these really exciting companies that are going to be some of the biggest winners in the years to come. So really it's an exciting time to be an investor. There's so much going on, so many opportunities out there. So I hope that's helped. I hope that's given you some information and made you feel a bit more positive about what's going on. So thanks for tuning in. If you did find value in this, I would really appreciate it if you could hit the like button. It really helps me to keep creating these videos and helps me for the YouTube algorithm. So thanks a lot, and I'll see you next week.